Everyone talks about buying in the dip, but what if the market never bounces back, even after a long period of time? So today in this video, I'm going to talk about counter-cyclical investing or buying in the dip, when it actually works and when it could be a trap. Counter-cyclical investing, this sounds smart. You're buying when the market is cool. You're buying when prices are affordable. You're not competing with others. So you just buy the property and wait for the market to turn and go up in value. Sounds very simple, right? And in 2025, there are more reasons why you should counter-cyclically invest in property, especially if your budget is under that 500, 600,000 price point. So there are two reasons for this. Number one is that there are not many markets available, strong markets available under 500,000. So you can't just wait until these markets become hot and then start to invest, because then it would be too late. And number two, buyers agents are already active in the hot markets. So if you go to these hot markets, you're going to be competing with these buyers agents and investors and potentially overpaying for property. So it does make sense to get into cooler markets early before they turn to make maximum returns on your investment. But it doesn't work with any market. There are some fundamentals that market has to have before you decide to counter-cyclically invest there. And in this video, I'm going to walk you through those fundamentals, the things that you need to check before you jump into an area and counter-cyclically invest. For those of you who don't know me, my name is Jadhu Srikandan. I'm a buyer's agent for property investors, and I buy properties all around the country using a data-driven approach. So if you want to work with me, go to my website, propertyframeworkbuyersagency.com.au, and book a session with me there. In this video now, I'm going to talk about 5 fundamentals that you need to check before you counter-cyclically invest in a region. And then I'm going to show you a real life example. I'm going to run through a market which is primed for counter-cyclical investment, and I'm going to show you real tools and data, how I validate this market. And finally, I'm going to show you how it's possible to spot early signs that a cool market may be about to turn. So that's what's going to come ahead. All right. So what are the 5 fundamentals? Okay. Before I get into a cool market, I want to make sure that I'm checking all this. If even one of these fails, then that might not work for you. Okay. So number 1, economic diversification. So what this means is that the area has to be strong and economically diverse. We want many industries powering that economy. You can use REMPLAN to check economic diversification. So just to give you an example, here I have the output for the Mackay region, and I can see mining contributes about 60% as an output in the Mackay region. This gives me the indication that the area is economically tied to the mining industry, and therefore I'm not going to counter-cyclically invest in Mackay. Now, don't get me wrong, Mackay is a hot market right now, but when Mackay was cool, let's say 10 years ago, around 2014, 2013, when it was a much cooler market, I still would not have selected Mackay to counter-cyclically invest because I know it's not economically diverse. Okay, so that's the first point. Number 2, unemployment rates. Now, the unemployment rates are directly linked to the health of the economy. So if an area has high unemployment rates, much higher than the national averages, then that area is not primed for property price growth. Could be several years before the economy changes. So for example, look at this. Greater Adelaide between 2011 to 2020, the unemployment rates were much higher than the national Australian averages. And therefore, I would not have counter-cyclically invested into the Adelaide market between that 2010-2015 timeframe, because unemployment rates were rising. Number 3, population movements. You want people to move into that area, especially more important for regional markets and smaller capital cities. You want people to move into the area because of jobs, because of lifestyle and affordability and things like that. So if the population movement is negative, that means there's fundamentally something wrong with the area. For example, let's look at Perth between 2012 to 2020, the same time frame. We're seeing negative population growth here. So that means people are leaving the area. Okay, so again, population movement is an important factor. The next one is rental market strength. Now, we don't want to invest into an area which has a weak rental market, right? So this means that either there's too much rental properties available or people just don't want to live there. There's no rental demand. We don't want to get into such markets. So go to places like SQM Research, look at the vacancy rates, make sure that the vacancy rate is at least 3% or much lower than 3%. That's very important. And the last one, we don't want to see cyclical growth patterns in that market, okay, over the 30 years or so. So any market that has shown cyclical behavior, that becomes risky to counter-cyclically invest, and especially negative growth over a long period of time. For example, I've shown here Moranbah, which is a mining town in Queensland. And you can see it shot up between 2002 to 2008, and between 2012 to 2018, then the prices just went back to what they were. So when the growth is cyclical like this, it's not a good idea to go and invest counter-cyclically in that market. Okay, so we want to invest in markets where there hasn't been too much negative growth or those dips haven't lasted for a long time. We want to invest in such markets. So it's important to consider that as well. Now, we've run through the 5 main things that we need to check. Now, I'm going to take a real-life example and look at a market where it is possible to counter-cyclically invest and which meets all the criteria that we discussed above. And that is in Tasmania, the city of Launceston. So why am I looking at Launceston? Because you can still find properties under 500,000 there, and the sentiment is low, but the fundamentals are still there for this market. So let me run through Launceston for you. Okay, so here I've got REMPLAN. I've opened up REMPLAN, and I'm going to go through the Launceston economy. The output here for Launceston is 12.5 billion. For a small population of 71,000 people, that's a fairly significant output, okay? And you can see that GRP has been steadily increasing over the years since 2019. In terms of the employment prospects, that's the next thing that I'm going to check, okay? In terms of employment, I can see it's dominated by healthcare and social assistance, retail, trade, education and training, and several other industries. And now I also want to check the output for the region, okay? Or the regional exports. Now, I can see its manufacturing contributes 18.2, healthcare and social assistance about 14%, financial and insurance 9.7%, and so on, right? So there is no over-reliance on one particular industry. So that's the key point. There are several industries, but not because you don't see that domination in one industry. Okay, and that's important. Now let's look at the unemployment trends in the city of Launceston. Okay, I'm going to compare this with Australia. So you can see, yes, unemployment was high and higher than the national averages for quite a period of time. But since 2021, this has been significantly reducing. You can see that the unemployment rate has been significantly dropping in Launceston from about 8%, and then now it's sitting around 4%. So it's around 4% and just above the national averages. So that means the unemployment rate is healthy. The job market is quite healthy in that region. Now let's look at the population movement. So from here, since 2006, I can see a slow and steady increase in the population. Nothing too significant, but it hasn't lost population either. So the population has been slowly and steadily increasing. So that's good. It's good, right? Now let's look at the long-term performance of Launceston, right? I'm looking at the 30-year time frame. So I've selected 5 suburbs in the Launceston region, all under 600,000, and I'm looking at their performance. So the graph shows slow and steady growth, some periods of stagnation, but overall it's been moving upwards, right? And then since 2022 onwards, as we know, it's been stagnating. And if I look at the long-term averages, look at this. It's between 6 and 7%. All these markets, except for South Launceston, which is at 4.96, I can see the general trend is around 6 to 7%. So generally a healthy market over the long term. Now I want to look at the market data in the Launceston region, right? So I've taken 5 suburbs, the same 5 suburbs. Let's look at the median price here. As you can see, median prices were increasing till about 2022, and since 2022 there has been a period of stagnation. Okay, so it's a cooler market that we are looking at. All right. Now let's move to the next factor that we need to check, and that's the vacancy rate, the rental demand. So vacancy rate for these markets, everything is around under 1.5%. So a healthy rental market for sure. Let's look at the sales days on market for these 5 suburbs. We have days on market which has been trending low since January 2024. So you can see that it's coming down, and now it's sitting anywhere between 20 to 30 days, which is meaning that the market potentially could be turning here. Okay, let's look at the listings volume, okay, which is an important indicator. Again, a similar pattern can be seen. High listings in July 2023, but that is starting to reduce and come down lower as time goes on, right? So it's starting to reduce here. Let's also look at the inventory levels, which is an important indicator. Inventory, again, similar pattern. Inventory is starting to drop for all these suburbs, and we can see it's sitting around 2.5, and in some of them even 1 month of inventory, which means that inventory is slowly tightening in this region. Okay, and finally, I'm going to just look at the absorption rate. The absorption rate for all these 5 suburbs. So the 5 suburbs here, you can see them on screen: Summerhill, Newnham, Ravenswood, South Launceston, and Mowbray. The absorption rate is definitely improving here. 50%, 36%, 33%. So that's a healthy market, okay? So this means that this market, while it has been stagnating over this 3 years, it's now starting to slightly recover, and there might be some opportunities opening up here. I want to also make sure that the region has got all the infrastructure and amenities in place. So I'm going to look at this. Does it have the basic things needed for people to live? So this one is the University of Launceston, which is the University of Tasmania Inversec campus. So it has the university over here. It has a major hospital, which is the Launceston Hospital, which is close to the CBD region around here. In addition to that, it has 2 major tertiary education centers, which is the TAFE. I'm just going to zoom into that. The TAFE, which is north of the CBD, and then we have the Launceston College, which is just around that CBD region. I'm just going to zoom into that. You can see there is that Launceston College here as well. In terms of the CBD, this is the Launceston CBD area. It is a fairly big CBD for a regional market. There is that Brisbane Street, and there's a big mall here, the Brisbane Street Mall, which has a lot of shops, and then there are a lot of trendy cafes, restaurants around this CBD region over here. Now let's look at the airport. So the Launceston Airport is just outside the city. It's just over here. Just going to zoom into the airport. This is where the Launceston Airport is located, and there are daily flights into Melbourne and Hobart from the airport. It does have numerous schools, numerous daycare centers, primary school, secondary school, all that type of thing is already in place in Launceston. So it does have the basic amenities needed for people to live and work there. Okay, there was also other projects coming into the region. The Launceston City deal was announced a few years ago, and through this project there have been upgrades to the Launceston University. Okay, a 300 million upgrade where a new building was opened up, where more people can train, where more students can come in and learn more things. Then there's a plan to upgrade the hospital, the Launceston Hospital, which is a $500 to $600 million upgrade, and that means that's going to attract more skilled workers into the region. The Launceston CBD area, there's a 20 million investment into upgrading the Launceston CBD area further. So this city deal, which was announced, is going to change Launceston and make that a vibrant and a good place to live in. I've run through the fundamentals of Launceston, why it could be a good place to invest counter-cyclically, a good place to get in before the investors and the buyers agents are into this market. So I hope you found it useful. I've also made another video recently about how to analyze a market. So if you are interested in how to do market analysis, go and check that out. That's all from me today. I hope you found this content useful. Until then, I'll see you in my next video. Thanks.